So today we are talking on revenue, which is IFRS 15, revenue from contracts with customers. So I will start by explaining the meaning of revenue before going into the 5 core principles that guide IFRS 15. So the meaning of revenue is an amount of money that we get from goods or from rendering services before all expenses has been deducted. So the 5 core principles that guides IFRS 15 are number 1, and these 5 core principles must come in order. You cannot skip the first one and go to the second one. It must be in order. So the first one is that you must identify the contract. The second one is that you must determine the performance obligation. The third one is that you must determine the transaction price. And the fourth one is that you must allocate the transaction price to the performance obligation. And the fifth one is that before you recognize revenue, you must recognize revenue after the organization is satisfied with the performance obligation. So my colleague will continue with the 5 core principles. Thank you.
Okay, still on IFRS 15, which is revenue from contracts with customers. I'm going to talk on one of the steps from the 5 core principle framework that my colleague spoke about. So that one is the identification of the contract with customers. And before a contract is accepted to be a contract, there are some 5 conditions which must be met before a contract is accepted to be a contract. The first is the approval from the parties. Both parties must approve that a contract is to be in place. The second is the rights of the parties in respect to the contract. Each party have their own rights to play. They have their own parts to play in respect to the contract, and so they must be well laid out and identified before a contract can be accepted to be a contract. The next one is the terms of payment involved in the transfer of goods and services in this contract. So the terms of payments must be identified, whether to be payments by installation, whether all the goods or services are to be rendered at once or in parts. And the next one is the consideration. It must be probable that the consideration that the firm is entitled to in this contract must be collectible. That means it must not be as bad debt or as a loan. It must be probable that they are sure they are going to get this money as revenue. And then the last one is that the contract must be of commercial nature. That means that the goods and services involved in this contract, they must have some monetary value attached to them before they can be considered a contract. And not 1 or 2 only of these 5 conditions must be met before all of them are considered before this contract is considered. All the 5 of them must be met.
To continue from what my colleague have said, on IFRS 15, I'm going to talk on the second and third step. The second step is that revenue is recognized when performance obligations have been carried out. You have to state out the different performance obligations and then ensure that all of them match with the contract and the agreement. The third one is that revenue should also be recognized when transaction price have also been analyzed. A typical example can be if you order maybe a chair or a furniture at 50,000 naira, the cost of the furniture might be 40,000, and maybe the cost of delivery can be 10,000, but the transaction price is the 50,000 naira, and all of that have to be agreed upon.
I will continue from where my colleagues stopped. So I'm going to talk on the number 4 and the number 5. The number 4 on this IFRS 15, allocating prices obligation. So we have to allocate prices to this obligation, which will now constitute the prices for the performance of obligation. And then the last one, which is recognition of revenue. Recognition of revenue must be recognized when both parties in this contract are satisfied. Thank you.